Good evening, everybody. Welcome to Finet SG with Xian Wei. Welcome. Hope you had a good dinner because I'm gonna start right away. Okay, my friends, we are on episode 16 already. So it's been 15 episodes of case studies, and today it's a little bit more special. I wanted to have an opinion piece with you. Is value investing dead? Or has it evolved? So we'll not go through the case study this time because we've gone through quite a bit. It's been 4 types of companies already, and I would like to give a piece, an opinion piece to this Finet SG. So I will start straight away on here and give an introduction for my new friends. Hello, and I'm Xian Wei, and I'm in the business of investment risk management. So I've been a client of Unicorn for 6 years already, and I was a client of Unicorn at 25. So with $25,000 worth of assets, with a good partnership with Unicorn, the relationship that I had and the financial education I've received, and also my openness and my appreciation for what they have done for me, I amassed after 5 years up to $200,000 worth of assets. It's really pure joy. And 2 trigger events in my family that actually got me started into expounding beyond myself to really want to provide for my parents and eventually to my loved ones and friends and so on, and all their referrals from there. Today I'll go a little bit deeper into how I actually got started, because it was this trigger events, right? These 2 trigger events. I'll just pick one of it. It was when I found out that my father has been asked to retire from ST Engineering. So that's one of the companies I've done my case study on, right? And it's not something that he wanted in the first place. So being at 63 back then, and also being a superb saver, which is very relevant for his generation at that time to save, simply because the bank rates were also doing very well. And because of that, he thought that after saving a big sum of money, 6 figures, he'll be able to retire with peace, and be comfortable traveling whenever he wants with my mom, and also eventually just chill and relax. But the first concern came to me when I realized that, actually if I just do a simple calculation of another 30 years, now the lifespan is getting longer and longer for all of us, especially in Singapore. Then my own grandmother at 91 and still very, very healthy. So that's his mother. So projecting 30 years is quite reasonable for my family. And dividing 30 years from the 6 figures and coming in, dividing another 12 months is actually not enough. So that's where I really seek for solutions, financial solutions. And that gave me a lot of opportunities to really become a consultant of Unicorn, and also expounding all these values towards my friends, my loved ones and friends. So that's one part of me that I would like to share in detail, because I do hope that it will inspire you somehow to also take note and be aware of the future consequences of today's decisions. We have come to an environment due to pandemic. The economic environment has changed a lot. And the 15 episodes I've been giving to you, sharing with you, especially on the financial wisdom, has been of great help to bring awareness. But it doesn't stop there. Awareness will not get you the true meaning of financial freedom or financial independence. So find out today, maybe in a little deeper sense, of what it means to actually get your finances or moving from your current financial position to a higher ground. Okay? So my question is back to this. Is value investing dead? Or has it evolved? So before we carry on, right, it's important for me to share with you what is actually the definition or the conventional meaning of value investing first. Because it came from Mr. Warren Buffett, right? As we all know, that is the grandfather or the father of value investing. Okay? So for that, and what does it happen, or why do people say that value investing is dead? Because that has been part of the talk. So definition of value and growth stocks will actually help you to understand what is value investing. Okay, conventional way of it. Value stock. Value stock is actually a stock that trades at a lower price relative to its fundamentals, such as the dividends, the earnings, the sales, making it appealing to value investors. So that really reminds me of Benjamin Graham, the teacher or the mentor of Mr. Warren Buffett. So for him, it's looking at the fundamentals. That means looking at a good quality company of the 4 tenets that I've mentioned before and valuing it, understanding its value and trying to wait for that value. Okay? So what is considered a growth stock? As you can read here, growth stock is actually any share in a company that is anticipated to grow at a rate significantly above the average growth for the market. So that is the difference between the two, which I want you to understand what it means after that. So that's the reason why probably people say that value investing is dead. Okay? So if you look at this, looking at Russell 1000 Value Index, if you just follow value, you will understand that actually the growth has given much more weight to value itself. So that's why people are beginning to understand that perhaps we can drop off the idea of value investing and go for growth, which was the 4th category that we're all aiming for, structural growth type of companies, because the difference can be great 2 times. Then I will share, maybe I bring you to this simple exercise where you can really think about it for a moment. If you had $1 million with you, okay, and you would like to buy up a company, so what would you pay for? So company A with a consistent profit of 100,000 per year for the next 15 years, or company B owning double of the profit in the first year, but its profit is declining 20% per year for the next 15 years, and assuming on the 16th year it goes bankrupt. And company C, a profit half of company A in year 1, but its profit actually grows 20% per year for the next 15 years. I will give you 5 to 10 seconds to think about which company will you choose so that we can enjoy this exercise together. But take note, please ignore the time value of money for this exercise, so purely just look at these 3 options. Okay, so to give you a little bit more heads up is to help you understand eventually how it looks like. So in terms of company A, with that consistent growth, is quite obvious, $1.5 million. So if you have put in $1 million, it's quite a fair deal, right? After 15 years, you might get 50% of the gains. And if you buy into company B, you actually started to make a loss after a while putting in that $1 million. And take a look at company C. So it's quite interesting, right? If you do go for a growth company, then you can actually get much more in return. It's in 3 times, 3.6 times. So what is it got to do with what I'm going to share? Do you want to give a guess? Okay, the conventional way of it is really looking at the value companies, right? So they place a lot of emphasis on what they can see today and the past. So they don't look at the growth side of things. So they will look at, looking at price to earnings ratio. So it's all historical. And if you put in the $1 million, right, then from the calculations in a conventional way, you will realize that company B is something that you might go for if you follow the conventional way of valuing companies, because it's cheap. Because it's coming into this PE, price per earning ratio. Simply you just do the division yourself. You can see that it's actually cheap to buy up company B. But we have seen already in the end what happens if you invest into company B. And you might not even be interested in company C, which was actually the ultimate growth for your assets. Okay, even if you look at the dividends per share, if you take a look at it as well, you will also see that it looks expensive in the very beginning for company C, because the dividends is normally correlated to its earnings. So you will also see similar valuation if you do it the conventional way. That is still, company A is fair, then cheap for company B and company C very expensive. You might just ignore it. But I would like to share a little bit more on this. Growth and value investing are actually joined at the hip. What does it mean? To me, they are actually both the same thing. They are valuable because of its potential growth. Now, the interesting thing that I want to discuss with you, or at least have a sharing with you, is that how will we know if it's not going to be shown in the financials on a historical value or the present value? So how are we going to make sure that this company will grow in the next 10 to 15 years? Right? That's the reason why conventional companies, conventional way of valuing companies, people think that value investing is already dead, which means they're buying up cheap companies. Because what happens when you buy up cheap companies and they get cheaper and cheaper? I shared this on many episodes, that if you do realize Singapore companies in itself, the Singapore stock market, 80% of them from the STI index belong to this category called cyclical growth. So what does it mean? It really follows the economy. And that means if the economy is bad, the company will not do well. If the economy is good, then the company will do well. So in that sense, if you buy, let's say, a company now, for example, SQ, it is actually very cheap. And you do know that, perhaps it's branded and Singapore government will definitely support it, right? That even if you buy it now and you know that it might take a while to grow, then you might still make a profit after this. But how long do you think it will take to grow? Just want to reiterate on the new environment that we're going through. Because if you buy it cheap, even if it doesn't get cheaper, just imagine the recovery period that is needed. We have understood for SQ, at least for the aviation industry, for it to really resume its normal traffic, they're projecting 2024. So 4 years of waiting, and we don't even know whether it's going cheaper or not. Then let me bring the perspective to you. Are there other companies that are more worthy of your assets? Because ultimately, why are we investing in the first place? Are we just making more money? It's not just that, right? It came from the fact that we really want to provide, at least for ourselves, to empower ourselves to be financially stable, and eventually, if there's a possibility, then also we can provide for our family and friends who are in need. So I urge you to really, on top of the awareness that you have received for the last 15 episodes, bring yourself to really ponder on this question and assess how you're going to move on from this financial position that you're in. It's going to be a long haul for all of us, and I would really like you to ponder upon this selection of your wealth, of really investing in the right companies for your wealth creation and your wealth accumulation. So I mentioned last episode, what are the two things? Today I have a third one to share with you. The first one is that you really start to do it on your own. I've given you a heads up, or at least a starter kit, to help you understand how to analyze companies. Or you can always speak to me if you want more tips or more exchange of ideas on how you would like to take care of being in this new economic environment that we're all in. It's a global pandemic. If not, do seek professional partnership with someone that is reliable to you and someone you can trust. Expose yourself to the experts, or at least the people who have done their homework and their analysis, and allow yourself to understand if it's a philosophy that you like to follow. And enjoy the session by reaching out to me and really understanding where you're coming from and how you would like to accumulate your wealth in the way that you're looking at. And the third one, for my friends here, or for my loved ones and friends who have already gotten their own portfolio and is going in a direction where you're not happy about, okay? Then seek your consideration to understand whether there's a need for portfolio repair or not. Because if you look at your money as a whole, it's very important that it continues to grow and not just on the fact that you never mind, I will try to hold out. So these are the 3 things that you can do in terms of your action plans. Okay, the round table of 8, I always like to share a little bit deeper about what we can do in terms of unicorn financial solutions. This table is very important to most of us. I've met really a lot of people every day, and I understand that close to 90 to 95% of them have not even come into contact with this before. So I'm really, really keen, or at least very happy to share what are the services that we have over here. If you take a look at the 8 of them, the first 3 are definitely the fundamentals to really understand your own financial position. And the rest will come in very, very helpful to you. Okay? So last but not least, I'm looking at sharing. I'm sharing on what I can do for you. Advisory on cash flow management and budgeting. That's really one thing. The second thing will be advisory on optimizing resources to increase the overall returns for your assets. All right, I will continue on this topic on whether value investing, is it dead or has it evolved? Because I haven't touched on the second part. Has it evolved? We don't know yet. But it will come on next week on Tuesday, 8 p.m, where I talk about part 2 of this topic. Okay, so stay tuned and enjoy this very short note or opinion piece from my side, and also hopefully it inspires you to share and ask your loved ones to really register for the next episode. Okay? If not, if you have any questions, contact me directly. It's not meant to give you any advice online. So if you do seek more specific questions answered or addressed, come to me directly. Or you can scan the QR code and post your questions there, and I will get back to you. If not, I will see you next week, my friends. Okay? See you!